The following content is meant purely for educational and informational purposes and should not be relied upon as financial, investment, legal, tax, or any other professional advice. This is the Fundamentals Podcast, where we demystify crypto and help you navigate this ever-evolving internet-native economy. In this episode, I'm joined by Darren and Dimitar, the co-founders of IPOR Labs. IPOR is a non-custodial exchange for interest rate swaps built on Ethereum. To cover the basics, decentralized derivatives exchanges are smart contract-based exchanges that allow users to mint and trade the synthetic versions of different assets globally. On-chain derivatives exchanges bring tokenized representations of all asset classes within the reach of anyone with an internet connection. As a DeFi protocol, IPOR refers to a series of smart contracts that provide a benchmark interest rate and enable users to access interest rate derivatives on the Ethereum blockchain. That's possible by combining three core pieces of infrastructure: the IPOR index, the IPOR AMM and liquidity pools, and asset management smart contracts. IPOR is an abbreviation for Inter-Protocol Over Block Rate. It derives its name from major indices from traditional finance like the LIBOR, the London Interbank Offered Rate, and the SOFR, Secured Overnight Financing Rate, and adapts it to DeFi. IPOR's mission is to become the foundational layer of the DeFi credit markets. Calculated and published on-chain, the IPOR indices are a public good that anyone can reference and build upon. In this episode with Darren and Dimitar, we discuss what IPOR is, how it works, its core value proposition and position within the market. Also, we dive into IPOR's financials, the upcoming version 2 of the protocol, the team behind the project, exciting upcoming developments, and more. Hello, Darren and Dimitar. Welcome to the Fundamentals Podcast. I'm excited to have you guys on.
Thanks for having us. We're excited to be here.
Awesome. Now, before we start diving into the details of IPOR, it would be awesome if you could just give a quick introduction for anyone not yet familiar.
Yeah, so sure. The IPOR protocol is really two things. It borrows from TradFi and the use of benchmark interest rates for structuring of deals, derivatives, something like the former IPOR or something like the SOFR. So it's really focusing on what's the cost of capital in the market, and then it applies that to blockchain. But instead of having something that's self-reported by a bank, which, in the LIBOR sense we know can be manipulated, we do transparent smart contract to smart contract calls to really source, what's the cost of capital inside of the DeFi credit markets. And so the IPOR is a composite benchmark rate between Aave and Compound version 2s, and that's printed to chain every so often. Right? And that can be used to structure different credit products. For example, it's a public good, it's a free data point. And so really on the other side of the IPOR protocol are the interest rate derivatives. Interest rate derivatives allow you to hedge your interest rate risk. So for example, the first product is a 4-week fixed for floating or floating for fixed interest rate swap. And essentially someone is trading against the direction of the index. So we can consider this then the first instrument that actually references the IPOR. So how that works is it's a peer-to-pool model. So we really took kind of the best of DeFi and the best of TradFi. So in TradFi, you really have your central entity, which is essentially the broker, which is matching the deal terms between different parties, typically two different financial institutions looking to exchange cash flows. In the DeFi sense, you have this kind of passive underwriter. So another way we can think of the IPOR protocol is this decentralized investment bank, especially the fixed income division. So this capital pool, it underwrites the swaps. You have an AMM, which is bespoke for the IPOR protocol, which is actually tuned to trade the volatility of rates that you find inside of DeFi. And that effectively gives you RFQ, which is a request for quote, which means it sets deal terms and the trader can choose to take it or leave it. And they're essentially trading against the pool.
Thank you for that comprehensive overview. Now, how would you summarize the core problem that IPOR has set out to solve? So in other words, what is the purpose of your being?
So if we look at traditional markets, right, we're talking about mature credit markets. Interest rate derivatives are the core, the underlying of the traditional credit market. So if you look at the market value of global debt, it's around 112 trillion, right? The notional value of interest rate derivatives is around 450 trillion. So a little over a 3x of the market value that's actually existing in the debt markets. So its purpose is, you kind of have three purposes, right? Which is any derivatives market, right? You'll have your hedging, you have your arbitrage, and you have your speculation. So if you want to learn a little bit more about this, both in the TradFi and the DeFi sense, our head of business development, Konstantinos, he wrote a relative value thesis for DeFi, and this is an overview of rates trading. But in essence, it allows people to fix their cost of credit. So if we look at some, let's say, recent failures like Silicon Valley Bank or Silvergate Bank, we can trace these back to two really failures in risk management. One is duration risk, right? They had these long dated instruments, but the other one is interest rate risk. They had these long dated bond portfolios. Bonds have an inverse relationship to interest rates. So as the Fed hiked the interest rates, the value of the bond portfolio dropped and they weren't sufficiently hedged, right? So effectively what an interest rate swap allows you to do is to hedge for uncertainty in the movement of rates. And another outcome of this is potentially like a fixed rate mortgage, right? If you take a fixed rate mortgage and you want to guarantee that for 1 year, 5 years, 15 years. There's typically a derivative that is maintaining this kind of payoff structure for the institution that's offering you the loan. And then there's some margin baked in there. And so that's another kind of outcome of interest rate derivatives. Then how does it play into DeFi? Well, DeFi needs maturity. I mean, in the sense of like growing up and not being so wildly speculative and very short term, but also maturity in the sense of long dated maturities or extended tenors, right? So if we want DeFi to really be useful, instead of really looking for flash loans, we need to start thinking of how do we get to a 30-year loan so that you can actually source this retail mortgage from a decentralized financial application. So we really need two things, right? And going back to the Silicon Valley Bank example, we need to actually facilitate term structure. And so these IPOR rates are currently a spot rate, but they'll be extended into the IPOR 1 month rate, the 3 month rate, 6 month, 1 year rate. So effectively, what is your estimated cost of capital, over the next year? And then this suite of interest rate derivatives that will allow you to actually hedge your interest rate risk. And so we think that these kind of two crucial pieces will help users inside of DeFi mature. It will provide these kind of fixed income instruments that traditional players are used to and are actually a requirement to be able to manage your risk. And through that, we can actually see an influx of liquidity into the DeFi credit markets.
Yeah, that's definitely a problem worth solving. So I'm glad you set out to do that. Now, Darren, in the introduction, you mentioned your interest rate swaps and a bit of how they work, and then also the IPOR index. And I thought it'd be great if we can kind of break down your whole product suite in a bit more detail at this stage, starting from nutshell type of overviews of each and then progressing to how they work under the hood. So a technical description of the smart contract architecture related to your products.
Okay, maybe I can talk about this, in terms of function, and then Dimitar can go more into the technical overview. So if we go back to that kind of first example or analogy of IPOR as a decentralized investment bank, you effectively have capital that comes in, and that becomes the balance sheet of this, let's say, decentralized investment bank. The purpose of that is to underwrite interest rate derivatives, right? So there's three indices: USDC, USDT, and DAI, because those are the credit markets that have the most volume. And each of those pools underwrites the derivatives in their particular asset. So, for example, there's this liquidity that's set aside to underwrite swaps, right? While that liquidity is sitting idle, it's actually going out to yield from the market. So this is a sort of, when a stock gets included in an ETF, right? The stock benefits because the excess, the liquidity, when someone buys a product, it goes to that specific stock. So for example, in the IPOR index, the IPOR is a composite rate between AVE and compound. And that means actually in this asset management feature for the idle capital that's not currently being used to pay out the interest rate derivatives, this is going out to the very markets that comprise the IPOR index. And so this is an added value, if you think down the road, why would a protocol want to be included in the index? One, for representation, right? To actually have its rate dynamic reflected in this index. And also it gets some liquidity from there. So that's, let's say, kind of the base structure. On the AMM is actually where the most of the matching is happening, the trades, the quotes, the quote for price, and the settlement of the trades. And externally, there's also a power token infrastructure. So maybe I'll turn it over to Dimitar.
Yeah, maybe to expand a little bit like in detail on the architecture. So the three most like important parts of the protocol are like the IPOR index, which is like the Oracle, which is printing on chain. and then of course like the AMM and the asset manager. And to go into more detail, so like for example the IPOR index, yes, the one which is getting printed on top of Ethereum every so often, that comes with like a whole host of problems. Like how do you optimize, when do you print the index, under what circumstances is that going to actually be published on chain? We know that Ethereum, it can be quite expensive, especially if you want to like publish something on chain every block. So there has been like a lot of design thought into how can we build the index, the oracle, in such a way that not only provides like the greatest benefits for the IPOR protocol, but also like for third-party protocols that want to utilize the index. Yeah. So when exactly is that going to be printed, under what conditions? So we have something called the heartbeat, which basically, in a very simple way, like if there is a bigger move in the rate, the index is going to be published more often. If there is not that much of a movement in the rate, there will need to be more blocks before the index is published. So this is like type of like the optimization. And then on the IPOR side as well, there are like some certain requirements where, for example, a big trader comes and he wants to like take a big swap. He has pay fix or receive fix, where actually that trader, by taking the swap, he is publishing, there is like that logic there that he's going to subsidize the publishing of the index before he takes the swap. So kind of like we get from the very big traders and we make it like much cheaper for everybody else to be able to trade interest rate swaps. Then for the AMM, obviously like this was the most challenging part, because we need to take like all of our quant models that have taken months and actually more than a year to create, and put all of that logic and all of that math to put that on chain, which was obviously it's a massive deal. It's one of the reasons why we went with that like request for quote construct in the first place, because I think that for interest rate swaps, using some simple concept like some XYK, it's just not going to fly. Yes. In order to be able to price this and price it at different tenors, you need like much more complicated math. This is the breakthrough that we are bringing to DeFi. In a way, those primitives for how to price certain derivatives. We know that in the option space, for example, even though they're using like the normal Black-Scholes formula there, together with some volatility that comes from an oracle, we know how inefficient that is for pricing like options in crypto. And then on our side, for interest rate swaps, I think that we're really paving the way for other protocols to build further on top of our work. And then the asset manager, it's when now it's becoming like more of a mainstream that unutilized assets are going to be deposited somewhere. Even if you saw like Uniswap v4, one of their points is like, you can build a pool that the assets are going to be in the credit markets and earn extra yield. We started doing this 2 years when we started building IPOR. So we really front run that entire movement. And of course it comes again with like a lot of challenges, how to make that gas efficient, how to optimize it for the depositors. So a lot of work was actually being done there, where we can ensure that when somebody comes to the protocol, he wants to LP in the protocol, he's not going to pay like $500 in gas fees in order, to be able to provide liquidity. So this is like high level of the like most important components of the architecture.
Got it. Thank you so much. And now, as we're speaking about like kind of the high costs of settling on Ethereum and bringing all that, what you spoke about onto mainnet, can you elaborate on what the reasoning is for setting everything up on mainnet instead of implementing on a scaling solution, or what your kind of multi-chain or chain strategy looks like?
Yeah, I mean, it's a bit because of the architecture, right? So if we look at what IPOR is, it's really the base of structured products on Ethereum. When we're talking about structured products, we're talking about, let's say, multi-calls that are tying in various protocols. You can call one protocol to another, you can base a rate off the IPOR rate, and you can do all these things, but you really need to have it done on the same layer. So for example, when we started this 2 years ago, or a little over 2.5, we were looking at the credit markets, and really it was Aave and Compound V2 that had all of the volume. We fast forward today and they still have the lion's share. So this is something that has some staying power. So for example, one of the processes about the evolution of the IPOR rate is, when does a new protocol get included in the rate? And it's probably some form of combination of time, which is a proxy to security, and some liquidity, right? Or when is a new asset, when is there an IPOR index spun up for a new asset or a new stablecoin, right? Again, something like time and liquidity. But all of the liquidity right now is currently on, Ethereum L1 and inside the credit markets. And really, we've seen it go across scaling solutions, L2s, rollups, and it's really also flowing between those, but then it kind of always comes back to the main net. So why? It's an infrastructure that is meant to be deployed on the most liquid credit markets because its function is to hedge those. Now there's talk, and also somewhere on the roadmap is deploying this infrastructure on other chains. The likely one would be Arbitrum at this point. But for example, you open up the idea of bridges and crossing bridges. So, if you're going to build a complex structured product, it makes sense from a security perspective to have it on the same layer rather than crossing a bridge. So for example, maybe a lot of speculative trading activity might happen on Arbitrum, while, the multi-calls that are actually taking the swaps in the background will be happening on Ethereum. We don't know how this is going to really evolve, but most of the presumption lies around if you have a derivative that underwrites, a certain market, then it should exist on that chain. And so that's why up until this time, it's been on Ethereum L1.
Got it. Thank you. Now, I do know that you are about to introduce IPOR v2. So could you walk me through what the main updates are that you are looking to roll out with that?
Yeah, so IPOR v2 is in a way an update, in a way a rebirth. So we have a pretty reflective process inside of IPOR. The reflective process is not just about our own processes and what we can improve, but also looking at the rest of the market. So for example, some things that are now really widely used, they weren't available at the time that we started building the protocol. So for example, we'll be using a diamond proxy, which allows for very simple routing, a very efficient routing. It also makes the user experience much better. You can do a lot of multi-calls on the front end. And this will allow also the product to become much more composable. And so why is that important, right? So maybe I'll sidestep. The big upgrade on the core product is the risk engine and actually the swaps themselves. So for the last almost year, so it launched last August, it's been underwriting interest rate derivatives, interest rate swaps, I think over 3.8, 3.9 billion notional traded. And that's really been on this 4-week instrument, which is very short, but maybe in DeFi it's long enough. But now comes the time to extend, the swap tenors. So this also goes with the idea of extending the term structures in DeFi. Right. So we have we published from the quant side, this really nice visualization of the yield curves visualized for USDC, USDT, and DAI. And that is part of what's going into the pricing of these longer duration instruments, right? So we'll have the pricing for a 2-month and 3-month, and we can easily extend that longer, but, we'll start with this kind of 3-month limits, see how the AMM performs, and then start extending that to 6 months, 12 months, right? So we'll get these much longer dated instruments. Another main feature that when we launched, we had cancelable swaps. Why? We wanted a product that meets or matches the very short-term nature of the DeFi users, anywhere from, let's say, a flash swap in a single block to a couple days, right? So this kind of 1-month swap really made sense at the beginning, but to actually be much more useful, and let's say the market is maybe less volatile and less degen now, you need to be able to extend the maturities of these instruments. Right. So we had to remove that optionality because it also adds for complexity on the quant models and the pricing, and it actually adds a premium. So we're removing this optionality component from the quant modeling and putting in a more market dynamic, basically spread behavior. And this is coming in the form of a secondary risk oracle. And secondary risk oracles or other oracles for pricing is something that we also see in a lot of other protocols, right? And so this is something that's going to be pricing for utilization in terms of notional exposure by the pool. It's going to be also pricing for things like, what's a rational amount of derivatives to underwrite given the current state of the money markets, right? So for example, if there's 100 million in outstanding debt on Aave and Compound, you don't need to underwrite 1 billion or 10 billion. Right. So also capping potentially the notional exposure to the size of the credit markets. And this kind of reflective pricing, allows the mechanism to be much more flexible. So you add that with the upgraded architecture, and this is the birthplace of structured products. So when we started this, again, 2.5 years ago, we thought that the market would be actually much more mature, at this point. And it's really not. But there's a lot of really cool innovations that are already happening. And so our assumption was, okay, we'll build these infrastructure pieces and other people will build on top of it. Okay, forget that. That's not happening. So actually, we're just going to build the integrations ourselves and offer the end products, right? So, it's really kind of positioned as originally as an infrastructure play, which it still is. But, if you think of like a car, right? We were building the suspension, we were building the combustion engine, but now we're just going to put the frame on it and give the car to the user, right? So this will be something like fixed rate markets, fixed rate lending, fixed rate borrowing. This will be something like being able to arbitrage the difference, the rates between TradFi and DeFi. For example, you see all of these real world assets, these money market funds, these treasuries being tokenized on chain, and really you can capture the arbitrage, between the DeFi rates and the TradFi rates. So, for example, if you're an ETH whale that has a lot of ETH that's staking, right? You want to take a very low risk. You can take actually a staking swap. So this is the next product that we're working on the derivative side to hedge your staking rate of return. You can pledge that in the money markets, borrow against that in cheap DeFi yield in high yielding TradFi, and potentially loop that. And you have really kind of two risk-free returns, which is, let's say, this risk-free rate of return that's hedged on the staked ETH side, and then the delta between the TradFi and DeFi money markets, right? And so this is kind of a looping flow that is also possible in the structured product side with a lot of these new products coming online. And then going back to the kind of the fixed rates, we have really cool new interest rate dynamics. Like if you look at something like Morpho, right? Morpho is really useful for IPOR because, first of all, the team, the talent, and from the DeFi safety perspective, it's one of the safest protocols out there. But it also creates a better rate dynamic for borrowers and lenders. What that also means is that the IPOR protocol can leverage these very deep pools to offer very deep credit products with an efficient interest rate derivative to give fixed rate products at the best rates on the market, right? So if you look at a lot of the other fixed rate products, they're going to be at a premium or a discount to the Aave or compound lending or borrowing rate. Whereas the IPOR rate and the Morpho construction, you can really have a better dynamic because you're basing that off of this mid-market rate. So it creates a much better dynamic. And, you're talking about, how much, 20, 50, 200, 500 basis points improvement on these instruments. And, then these instruments are not constrained to one pool's liquidity because of the composability. You can source it from the deepest and most liquid money markets with a very capital efficient hedge, and you have these very large structured products that are being built on top of the IPOR protocol. And so this is really what kind of V2 is about. So we call it the credit hub or the rates hub or the heartbeat of DeFi, right? So that's really what it is. It's the place that you come to trade rates, but it's really kind of the credit market hub of DeFi. And you have this IPOR index, which is the beating heart of the market. And they kind of all go in lockstep to make this kind of mature DeFi credit market a reality.
Okay, those sound like really exciting updates. So I can't wait to see that rebirth play out on V2. And I think it's not just us who would have thought that this market might have been a bit more mature at this stage, but slowly and then suddenly we're still approaching that suddenly hockey stick there. But if we look at the broader market in general, and I know what I'm hearing from you speaking about like the direction you're going to with IPOR V2 is that you're really at the middle of kind of the fusion point between TradFi and DeFi in terms of like the credit market, which is a pretty great position to be in because there will need to be pretty seamless interoperability between the two. And I'd love to hear your thoughts on the market in general, as it is not like mature enough. So what do you think of its state right now? And within that, how would you crystallize your unique selling proposition?
Yeah, so the markets are not mature, but they are getting more mature. I mean, we're seeing really cool innovations kind of across the spectrum. You have things like Frax, you have Euler. Despite the hack, they have they're pushing a lot of boundaries. And Morpho, I already mentioned. You have different derivatives on top of Uniswap pools that are trying to hedge impermanent loss. So you have a lot of let's call it like DeFi 1.5 or 2.0 primitives that are looking to tackle issues that were apparent in DeFi 1.0. If you look at the opportunities that we have on the IPOR protocol, you see everyone wants to do a copy paste of a perp decks, basically leverage trade sub-investment grade assets, we'll call them. But this is actually the same thing that Dimitar and I talked about, a long time ago. We're looking at this to say, okay, everyone wants to copy paste. Everyone is going to want to become, the decentralized, BitMEX or Binance or FTX with the perps. But the utility really lies on the other side, and actually one side fuels the other. So, we still see a lot of people trying to chase the perp dex craze, which is, it's nice, but it's not so useful, right? It's nice for speculation, but fixed income and the cash markets are the largest markets in the world. That was our thesis, and this also drives the asset market. So it becomes like a rising tide lifts all boats sort of scenario. If TradFi can pump, trillions of dollars into fixed income on DeFi through these IPOR rails, then really everyone is kind of celebrating. But that's also kind of a greenfield opportunity for IPOR, which right now it's the largest interest rate derivatives protocol in the space. And the whole purpose of this is to actually kind of grow this, not the share, but the share of actually rational fixed income on DeFi. And so this is what we hope is going to continue to mature. And actually, we see a lot of the maturity then also coming in with people like tokenizing traditional assets. So you get a challenging rate dynamic between TradFi and DeFi. So this, I hope, kicks off a lot of innovation around the interest rate dynamics, because the utilization curve model on Aave and Compound, it's nice, it's cute to jumpstart a market, but it doesn't make sense. It just doesn't make sense that we've been sitting here for the past year and a half, sitting around 1-2% while TradFi is going to 5%. I think this dynamic will revert, but we need a better kind of market inflective way to discover the rates.
Yeah, that definitely does make sense. I know this current kind of meme coin era of the crypto market, it requires a really different mindset to be able to think longer term and focus on building that instead of opportunistically like building infrastructure for the volume that people are trading with.
If we look at, let's talk about market share, right? Exotic derivatives, which, these perpetuals, as a subset of traditional financial markets, it's such a tiny slice, right? And so if we think these speculative, there may be a couple ones that are dominant in this space, but in the long run, it's the cash markets that are king. So that's why I'm happy to see, a lot of the different tokenization of different yields, of a variety of yields coming on chain. And this is why we focus on the cash markets, because they're useful.
And with this approach to the market, I'd be keen on hearing what the team building IPOR looks like. It seems like very long-term fundamentals focused mindset. So could you just walk me through both of your backgrounds quickly, and then what the broader team behind the project looks like?
Yeah, maybe I'll start then. So I'm actually like one of the most DeFi native members. Yes, I started very early in crypto with DeFi specifically. Yes, since 2017, I was advising couple of protocols there. I'm not going to name them now, but they turned out to be quite big protocols in DeFi. And I've been passionate about the DeFi industry since basically before the term was really coined, and specifically about token economics, how value flows in DeFi, who captures that value, how it is being distributed. So outside of that, I have also worked as a VC for multiple years. So I have worked with many projects to basically help them build their product and find their product market fit. And yeah, with Darren, we go way back, and I guess I'll leave that part of the story for him.
So Dimitar and I, we met in 2018, I believe. We were both living in Shanghai at the time, but we met in Frankfurt. So it was very funny. I was doing a panel, and Dimitar stood up very passionately. It was about security tokens, and he was saying, you guys want to shut off all of us who have passionately built this space for years. And so I looked at this 2-meter tall Eastern European in this threatening voice. I'm like, okay, so I have the rest of the day to live, so it's been a good life. So, but we really connected there. I've been building in crypto actually since 2011. So maybe one of the first kind of careers in crypto. Used to run BD. We were the number 2 exchange to MTGOX back in the day, called TradeHill, and I've been building ever since across exchange, across brokerage, payments, cross-border payments, L1s, security token infrastructure, and now leading IPOR. So actually through this career, it's really how we came to into this kind of the idea of IPOR, and this is what we were starting to talk about, like what's interesting, what's useful in this space, at the end of 2020. And Dimitar and I, we really connected around fundamentals. We're both fundamentals driven, which is why we forego a lot of quick, easy wins to try to tackle very large but very worthwhile problems to solve. And that's how we landed on IPOR, which is not an easy protocol, but it's really worthwhile. And so we started looking then into kind of my contacts book from being around for a few years, and we reached out to a couple of different people. And so, for example, our quant team is led by Mauricio Hernandez. So he is a PhD computer scientist and statistician. He set up the trading desk at SBI Bits. SBI is the large Japanese security broker. He's originally from Brazil, and he brought with him two super senior quants. So Lars and Ian, they both come with over, I think, 22, 23 years each in traditional fixed income as quants. So what that allows us to do, tap into their experience. Quant is like a toolkit, but you need to know which tools to use. So go into that toolkit, bring it out, test it against this on-chain testing suite that we've built in-house, and make design decisions based on the output, right? And then the kind of secret sauce is turning these complex models into something that's a good enough approximation of risk and cheap enough to run on chain. So that's really the beauty of IPOR. It's not reinventing the wheel, it's adapting this to a blockchain infrastructure. So I guess that leads us to the development team. So the development team are a bunch of super senior engineers. We actually have 3 PhDs total on the team, 2 on the quant team and 1 on the development team. But these guys are super senior coming from enterprise software development. And this was kind of a team building choice that we made that has really paid off dividends, which is convert enterprise software developers who are thinking about security, scalability, efficiency, and all of these things into smart contract developers. And so I reached out to Wukash, who I know from my time in Shanghai. He was the CTO of, I think, 4 or 5 venture-backed startups. He's really heading up our product and sits at the intersection of, business and the code. Mario is, we call him the heart surgeon. It's the heartbeat of DeFi. So he's doing the smart contract development, kind of the heart and core, of our smart contract team. I won't go into all the guys, but we really have this beautiful, I think, balance where we have strength across the board. So anywhere from the front end, both the interactions and the UI on the design side, to the smart contracts themselves, to the quant modeling, and then to the marketing and the community side. So even on the marketing side, Vlad, he's been building in crypto since 2013. And our own IPOR intern is one of the most famous intern accounts on crypto Twitter. So we have a very well-balanced team. I think we're 17 in total.
Okay. I love that. That's also a great kind of founding story on how you two found each other. Those are usually the start of something pretty cool. I love it. Next, I want to kind of move on to speak about IPOR's financials. And to start off, it would be good to understand the business context of your product. So could you walk me through how you generate cash flow with your different products to both the protocol and then any supply side participants that are involved?
Yeah. So at the beginning, like before we launch, yes, we had like one thing that we really wanted to achieve. And like as Darren was saying earlier, like IPOR is like that global investment bank, yes, which is underwriting all activity which happens in DeFi, specifically about trades. And then you think about, okay, what's the profile of the depositors inside that investment bank? Yes, like there is risk to be underwritten, but we know that majority of the time, like hedging rates, as interest rate swaps in general, they are a cost because you want to protect yourself or take advantage of some opportunity for which you are paying that premium. And usually, they are not as products, they are not as risky, for example, as let's say options, yes, or let alone perps. So in a way, what I really wanted to achieve with it is to build a protocol where any user that have some amount of stable coins in their wallet can put that stable coins to work and earn top industry yield. So this is really my goal because, again, as a DeFi native for me, I look at like, okay, why would somebody deposit their money with IPOR as opposed to, put them in Curve or Uniswap or some other protocol? Yeah. So really my goal was, you have 10, 50, 100K in your wallet. You don't keep it there. You just put it in a protocol that you know is safe and is going to earn you top yields. So for the majority of the part, like all of the revenue is created to go to the LPs. Of course, there are multiple fee switches and fee sharing modules that actually they are in the architecture by design, but those decisions are not to be taken by us. But there are proposals in the DAO for like, okay, should we do this right now or should we do it down the line? Yes, what is the pros and cons? And we have like a very active discussion actually about those things. For me, like when we are talking like about split between like the revenue that goes to the participants, like to the LPs of the protocol and so on, and the revenue that gets shared with, let's say, the token holders, IPOR as a protocol is a very different beast. Like for example, like getting some DEX and running it and issuing a token with it, because then you compete with everybody else which are exactly the same like you. So you basically have to compete on like, oh, who's going to create like better Ponzinomics and some form of token revenue share. And we also know that this competition with the fees and so on, it's a race to the bottom. Yes, it's like everybody are going to end up exactly like majority of the Chinese exchanges ended up back in 2015 2016 when they went into that competition. Another point for us is that the IPOR token by itself, IPOR is an infrastructure. Yes, it's not just a user facing dApp where somebody can come and they are going to give some input and there is going to be some output and there is going to be some value created there. Yes, as an infrastructure protocol that we expect that people are going to build on. Yes, and that this index is actually going to become something in the industry which many other protocols are referencing here. Like governance is not just a meme. It's not just something that you put there to say, my token is a valueless governance token. So I'm not going to speculate on the value part of it, but I think like for an index, that governance and being able to achieve that like vast distribution. Yes, so you can ensure that decentralization and multiple of opinions is very important when you are building something which is infrastructure.
Yeah, got it. That was a good overview. So, I mean, no revenue capture yet, which makes a lot of sense. I mean, feel a lot of projects have definitely rushed it as the market's not mature yet. So, you want to build that infrastructure. You want to really solidify your place. And once you have enough users, enough volume and traction, then you can work with the community to find a model that works and is sustainable in the long run. Makes a lot of sense. And as we're speaking about governance, could you walk me through the IPOR tokens' current purpose?
So, the two main like initial, that we have created that concept called like the power token. Yes, so this is something that we built as a public good. We have open sourced it for other protocols to be able to use, and that comes on the back of like 1.5 year of research, and seeing all the shortcomings, for example, from, let's say, something like whichever is the most popular, let's say like the V curve tokenomics, which while they work for Curve, it's very hard for you to make the case that they would work for anything else which is not Curve. And they also come with like very big restraints. Once you commit to this design, it's almost impossible for you to move out of this. Yes, and it's my very strong opinion that when you are launching like a DeFi protocol, when you have like a very long expected build time and scaling up time, because like we said, like the industry does not move from here to there in a week. Protocols go through different stages. Yes, you have your birth and like the token comes live and there is some like distribution between the parties, but then you start like getting your product market fit and now you need to care about other things, and then you go into like where you already an established blue chip, and then you need to think about completely different things. Yes, and usually all of this is connected to like, okay, how you're going to run your incentives, how are you going to distribute the value created by the protocol to the different shareholders and so on. And the power token design is actually focusing exactly on those problems. How can we build like the most flexible solution that is going to allow us in a most efficient way to make changes, let's say to the liquidity mining or to the governance or to delegation at different stages of IPOR development.
Got it. And then just a final one on financials related to venture funding. I know that a bit over a year ago, you announced I believe it was a $5 million funding round. I'd be interested in hearing how you kind of pitched the venture case for IPOR. Maybe, and of course, listeners can kind of piece it together from what we already talked about. But if you just want to summarize the elevator pitch here.
Yeah, the venture case for IPOR is really, becoming these core infrastructure pieces for the DeFi credit markets. So there are a lot of different ways that you can look at this from a thesis perspective. It's either the infrastructure play, or it's the DEX play, or it's the governance play. And actually, maybe different one of our VCs kind of represents some of these different players, right? Also, what we were looking for was anyone who has a really high kind of overlap, especially between TradFi and DeFi, or any very active traders who might use the instruments. Or, for example, our lead, Arrington, who has different plays in various money markets and in stablecoins across multiple chains. So that's really looking forward at the governance value of IPOR, as it grows, as it adapts, with the DeFi credit markets. So yeah, I mean that's in a nutshell how we pitched it.
To move on to kind of current and upcoming developments, with the market being in the state it is, a bit like tricky times in terms of regulation, lack of liquidity, and everything else. What are the main drivers or challenges related to your growth, like as of right now?
I mean, major drivers, actually really excited to see this kind of diversity of yields coming on chain, specifically the TradFi yields. But I also think that it's a bit short-sighted. Right now, everyone is looking at these high-yielding T-bills when all the banks are blowing up and saying, this is great, my yield here is going to be like this forever. It's not, right? At some point, we got to return dovish because a lot of things are breaking. So what happens with the DeFi yields at that time, right? Do they go back to this probably good premium because they're risk adjusted? Do we have some better rate dynamics? Maybe. So that's really driving this workflow, which is the idea of creating a two-way bridge between the DeFi and the TradFi yields, no matter which market is leading. And so that's one of the big focuses on the business development and the protocol development side, right? One of the things that's detracting is actually a lot of the actors who could have been individual traders of the IPOR derivatives blew up, right? And so this is something that last year, well, a lot of our potential, traders died, and maybe it's because they weren't hedging the risks so well. On the flip side, you have this general focus now on risk management, and people are now asking, where's the yield come from? So the IPOR protocol works very well in multiple cases for that. If you look at the IPOR index, you can consider it like the risk-free rate, or the best proxy that we have to a risk-free rate in DeFi. And that's really its purpose. So then you can look at that and you can benchmark your risk-adjusted yields. So you can say, if in an over-collateralized loan I'm getting 3%, on this on this instrument I'm getting 8%. Okay, so I have I'm overperforming the benchmark by 5%. But is that extra 5% compensated on the smart contract risk side on all of these things? So it also helps you to manage risk. So now that people are worried and a little bit more risk averse, it's a very good time to talk about interest rate derivatives, about benchmark rates, about risk adjusted return, right? And so that's a really good driver. The other driver that is really, I think, part of the next stage of IPOR with the V2 are the structured products, right? So these structured products are going to be using the infrastructure, and they're going to be using the swaps as an integration into a larger product. And so that also adds to the volume, because you have this kind of one-click approach. Okay, I want to borrow 10 million at a fixed rate for the next 3 months. I do one click. Oh, on the back of that, there's a hedge, there's a swap. That swap is underwritten by the pool. There's a fee that's returning to the liquidity providers. That makes the pools useful. That gives some activity on the DEX, and really that's going to be I think the major driver. So being able to offer this kind of in-product experience through actually the composability of DeFi, I think that's the biggest driver of IPOR in the V2.
Yeah, makes sense. And then just final question to wrap this up. I know V2 is coming up, but what's next? Is there like anything else outside of the stuff we already touched on during this session that you'd like to share about your mid to long-term roadmap?
Actually, for me, one of the very exciting things is that we spent like quite a long time to create like the power token dynamics and the liquidity mining of IPOR, yes, which is like I would say, we are talking here about fixed rates and credit markets and so on, but DeFi, a lot of DeFi is about like liquidity mining and basically people putting money there in order to obtain a token. And we really did a lot of work there, so it basically unlocked a lot of potentials for us. Yes, like an LP on IPOR can earn easily like 30, 40, 50% APR, and we have kept that since launch, yes, which is like almost 1 year already. We are basically topping the charts there on stablecoin yields weekly, and then on top of that you can use like the power token dynamics to have a multiplier on top of that yield. And it's a very interesting concept there. I'm not going to go into detail because probably it's going to take too long, but one of the problems that we had with the previous architecture was that between the providing liquidity and the credit market, and then also like having IPOR token and staking it for power IPOR and delegating it to increase your multiplier, and then claiming rewards and redelegating, it was like a lot of like approvals and a lot of transactions. And now there is that concept that I always wanted to have with power token, which is like choose my APR. Yes, like as a liquidity provider, you just come and you have, let's say, some USDC, and we give you an option. Okay, choose what APR do you want to have. Do you want to get like 15% APR or 50% or 110% APR? Yes, and basically the multico is going to allow for this to exchange the amount of USDC or the amount of IPOR to stable or to power IPOR, and put it in the right proportion in order for you to get the APR on the whatever remaining amount of stable is. Yes, to just play this and be able to much better optimize it. So with the new architecture, there is going to be like those capabilities of being able to do this in one call, and also with that means that a lot better also on the UX side. We will need to do a lot better on the UI UX on the app, which I think we are already doing amazing, but now with the multi-calls, it's going to be even better.
Maybe two last things that I don't think we got to focus on enough here. One is the ETH staking rate derivative. And so this is going to be one of the core products. Right now, there's the swaps for USDT, USDC, and DAI. And that has a captive liquidity of around 18 million right now. But being able to intake ETH, as this kind of underwriter for this ETH staking yield, that's another kind of yield source, right? So again, topping the charts on the rate of return for the stable coins, if you can build this kind of same functionality, the same fundamentals, and offer that for Ethereum, this is, I think, a huge opportunity. That's a kind of a very immediate term thing. One long-term thing is the IPOR as a data point. So we're also talking with different data providers. And so, of course, if you're watching this on the Bloomberg terminal, the idea is that on the terminal, you get, different indices, right? And so a lot of people in crypto Twitter, they look at IPOR and they say, oh, I can easily meme this, IPOR bro, or you poor bro, and that's okay, because it's someone who's going to be thinking like that. This maybe not going to be able to conceptualize the end goal of the IPOR, whereas someone who's going to be bridging in, trillions of dollars into the DeFi fixed income market looks and say, IPOR, oh, that's LIBOR for DeFi. So as part of a very kind of long-term, let's say maybe not necessarily DeFi native work stream, but kind of getting these tentacles, data tentacles into TradFi, is the dispersion of the IPOR index as the risk-free rate of DeFi, just as a data point. So this really kind of warms up institutional players to be looking at the IPOR as a data point when analyzing fixed income inside of DeFi. And then let's say these start to become or toe dip or become actors in the next 1 year, 2 year, 4 years, then IPOR is already cemented in the back of the mind as the risk-free rate of DeFi, and it kind of has a self-fulfilling feature. And maybe some of these guys, even if they're structuring their on-chain instruments off of the IPOR rate or even off-chain, the whole idea of accrual of value structured to the IPOR is kind of the end goal of the index. So that's another kind of long-term work stream that has a very long feature. And if we do reach our goal, it could have some of the similar kind of value accrual around an index that the LIBOR had. I think at peak it was something like $413 trillion worth of deals, debt, and derivatives were structured using the LIBOR. Instead of the LIBOR, which is manipulated by the bankers themselves, you get this transparent smart contract rate that's being published on chain, block over block, and this is a much better dynamic. It's much more open, and that I think is one of the end goals for the index.
A lot of things that I like about how you're positioning the protocol for kind of long-term value capture. Also focus on fundamentals and everything else. So at this stage, this is a great overview. Thank you both so much for taking the time to introduce IPOR and speak about the details behind everything going on and all the exciting developments to come.
Thanks for having us.
Thanks. Cheers.